Jilliene, Helman, thanks for coming on.
Thank you for having me.
Of course. This is an exciting show. I actually have been looking forward to having you on for, I think since we started this. I think you're probably one of the more interesting people I know.
You must not know a lot of people, Jack.
Jack doesn't know people. And I promise we're not advertising culture pop here.
I don't like that promise. I think we are.
Wait,
culture pop.
We want to get some. Yeah, we want to get some.
Matter of fact, send Jilliene a case
Check out
too.
Culture prop. Yeah. Okay.
But yeah, thanks for making the trek down to our Lower East Side abode.
Yeah. So normally we like to just get right into it and have you kind of talk about your background and RealtyMogul,
sure.
Which we've done business with and are doing business with and have a lot of respect for. I think it's easier for you just to kind of talk about your backstory rather than us try and talk about it for you. So
tell us how it came to be, and then let's hear about the business a little bit.
Sure. So grew up in a really entrepreneurial family. Always knew I wanted to be an entrepreneur. Always knew I wanted to be a CEO. I remember talking to my dad and him saying, you need to go learn something. Like you can't just go start a company, don't be naive, go learn something. So I went to work for a bank, about the most opposite of entrepreneurial that you could possibly go to. And every single day that I was working for the bank for like 5+ years, I would say, I'm going to start a company. I'm going to start a company. I'm going to start a company. I didn't know what it was going to be. And then in 2012, the Jobs Act came out, which essentially changed the securities regulations for the first time since the 1930s. And it allowed you to market investments on the internet, right? Like at its core, you could suddenly go online. You didn't have to know a guy. You didn't have to go to a country club. And we could buy advertising on the internet to sell real estate investments. And that was kind of like the core thesis behind RealtyMogul. Today, it's an online marketplace for real estate investing. We've been involved in over $7 billion of transactions, a handful of them with Jack. So thank you, Jack. A lot of it's been in multifamily. So 35,000 apartment units that we've been involved in. And really today, the core business is investing in real estate on the internet. It's the same thing that, we contemplated over a decade ago.
That's awesome.
It's really cool. I keep using the term democratizing. I don't even know I'm using that correctly here.
I can't stand it. We spoke about this already. I mean, it just sounds, it's like one of those, it's become one of those buzzwords that you just have to throw in.
Well, like everything's accretive now, I feel like, even more so. But I feel like you changed the game. And I know you've had competitors in the sort of the crowdfunding space, but not a lot of them have kind of made it.
Yeah.
And you were certainly at the very beginning you had no examples to go on. You were a trailblazer. Yeah. You're pioneering it. So tell us what that was like in doing this with nothing to go on, right? I mean, it's kind of on your own. I mean, what's the first deal you did?
Yeah, I would preface it by saying it's a lot of pain and highly unrecommended. Like we can talk about some horror stories.
I think that's been the one homogenous view from every entrepreneur. Like everyone,
in any company,
any company, it doesn't matter.
Probably
it always starts with "Don't do this."
Yeah. The first deal we ever did was a duplex in Compton. We were actually the lender, and it's my buddy Nick is the entrepreneur. He's a really, really brilliant guy, and I'll never forget. We drove up in his Cadillac CTS, and he gets out of the car and he goes to the trunk, and I'm like, "Why is he going to the trunk? We're like supposed to be going into the apartment unit." And he gets a crowbar, and I'm like, "Oh, I'm not in the right place. Like this is not where I'm supposed to be right now." And so that was the first deal that we ever did. It was a $110,000 loan on a duplex in Compton that probably should never have been lent against.
Jillien's like, "Oh my God, I left banking."
That's where it all started.
Yeah. So that was the first deal. And then, now we've worked on a $110 million development project in Miami. That's the largest project that we've worked on, to date.
So can I dig into the platform a little bit to understand what it is? So my understanding, at least, it's a dual side marketplace, right? So you're sourcing developers and whoever it is, private equity sponsors.
Yep.
On the other side, you're sourcing the investors. Does your entity have any stake in the game, or you're just bringing the parties together?
So we actually have 3 businesses now.
Okay.
It's called RealtyMogul. They're all sort of under the RealtyMogul umbrella. But the first business is what you describe, which is really this digital marketplace, right? We're sourcing sponsors. We're sourcing investors. We're putting them together. We don't have any economic stake in that, from an investment in the transaction perspective. The second business is a fund management business. So we launched 2 REITs. One's an income REIT. One's an apartment REIT. where we're the fund manager. So we built a registered investment advisor, we manage the REITs through that entity, and we're actually the fund manager. The third business is actually the business that we've done work with Jack, which is a real estate company. So we acquire apartment buildings, we renovate apartment buildings, and we really hold them for the long term.
Okay.
And for the fund management business and for the real estate company, we use the digital marketplace to raise capital. So it's kind of all in the family, if you will, but it's really sort of 3 core businesses under one roof. And we've got, general managers in each of those businesses that are kind of running each of the lines of business.
That's really impressive. Yeah, I didn't realize that you guys had all those components under one roof. Obviously the platform, like the marketplace is what comes to mind.
Yeah.
Especially when we talk about crowdfunding. Very cool.
Yeah. Well, so basically you have a sponsor. I'm going to dumb this down for people.
Please.
Everyone's like, we know this. It's a real estate podcast. So you have a sponsor. They're trying to raise money.
Yep.
They can go to their own friends and family. They can go to their own equity that they have lined up, or they can go to RealtyMogul. And RealtyMogul is basically going to say, hey, I like your deal or I don't like your deal. If I like your deal, I'm going to go out there and crowdsource for you and bring a bunch of equity and LPs to the table and then kind of handle the stress of that.
Yeah.
So what is it that you're, what's the value there that you're adding when you do that for a sponsor?
Yeah, so value one is cash, right?
Yeah.
Like cash is green. People need money to do deals. A lot of times sponsors will go to their own networks and then also come to our platform. So maybe they raise $5 million of capital from their own network and $5 million of capital on the platform. Suddenly they've got, the $10 million of equity that they need. Mm-hmm. And then we also have a technology platform after the transaction closes where we're helping to manage all of those investors.
Which is always a pain in the ass for any sponsor.
Yep. So sending out distributions, sending out tax reporting, sending out quarterly reporting, answering questions, right? We've got an investor relations team and an asset management team who can sort of play first line of defense on questions. Mm-hmm. If there's a question that we don't know the answer to or it's not the reporting, we'll send it off to the sponsor. But I'd say 95% of the time, we know the answer pretty black and white. We don't have to bother the sponsor.
Yeah. Well, what is it you're looking for in a sponsor? I imagine there's a checklist of things. Is it the deal that you're looking at more so than the sponsor themselves or vice versa?
Yeah, we always start with people, right? So like you've got good deals and bad deals, you've got good people and bad people. But if you're in a bad deal with a good person, you actually have a chance. If you're in a good deal with a bad person, you're done, right? Like there's no coming back from that. So it always starts with people. We're looking for track record, right? Mm-hmm. What have they done in their careers? What have they acquired? What have they sold? If they're entrepreneurs, what did they do before they started the company? What's the track record of the company? Mm-hmm. And also just like, does their business plan make rational sense, right? A lot of times we'll see these sort of far-fetched business plans and we ask 3 or 4 questions and, suddenly the entire thing falls apart, right?
Yeah.
So
20% rent growth year one.
It tells you something about the person, right? Yep. If I get anything in my inbox that's over a 30 IRR, I'm just like, no thanks. Yeah. Like this is just not a realistic entrepreneur. Or they haven't gotten beat up enough. Like I want the guys who've gotten beat up, right? I want the folks, guys and gals. I want the folks that, they've been through the hard times, they've been through the hardship, they've learned the lessons on somebody else's capital, not on my capital. And they've got some sort of bright-eyed, bushy-tailed people working for them that want to work really, really hard and are optimistic, right? That's kind of the duo that we're looking for a lot of times with sponsorship.
Right. No, makes sense.
Yeah, that's pretty funny that you say, in which form the deal comes into you, because I feel like the entirety of my career has been like, here's the real number, right? Let's say it's like a low 20s IRR, if even. Let's make it a 30, then send it out, and then we're going to allow them to beat us up down back to 20. I was like, why don't we just start with 20?
Yeah.
And that still hasn't changed, which is really weird, and maybe you still see that on the fund management side. But I want to go back to that first deal that you did. So post 2012, you launched RealtyMogul.
Yep.
Before you had 3 companies, what was the first company?
Yeah, so the first deal we ever did was actually a loan. So we were a hard money lender way back in the early days.
And was your plan to come out and just get involved in real estate kind of on the private equity or private debt side? And
yeah, our plan was always to do equity, but we didn't have access to capital to do equity. Like what equity or sponsor wants $110,000? It's meaningless, right? Why would they do business with us? It makes no sense. And so we started with these like rinky-dinky loans, right? $110,000, $150,000. Our average loan amount when we were in the hard money lending business was $240,000. Horrible business. I mean, just
tough to scale.
Really bad business.
Really tough to scale.
Really bad. Well, tough to scale. And then our average duration was like 7.5 months.
Right.
So the minute you originate, you're just like spinning this flywheel. Right. It was horrible. I mean, like really awful. So we got out of that business in 2015, spent, 24 months toying there. I got out of that business.
What was that like? I hate to cut you off. What was that like in terms of raising money from strangers on the platform for that first deal?
Well, were you raising money from strangers?
Yeah, we were raising money from strangers. So I remember our first investor.
That's going to be your new site.
Raising money from strangers. Right? I mean, it's taken you years to build up this investor database and have all this. So you had to start somewhere. So what was that like?
Yeah, so my parents were the first $25,000.
Okay.
A buddy of mine from college was another $25,000.
How interesting. Our parents are our first listeners.
Yeah,
oh, great.
They might be our only listeners.
Might be our only listeners.
I'll get my folks on. So we got 6 now.
Good, please. Yeah, we have 15 at least.
Sorry, I didn't mean to cut you off. So,
So, and then we had $25,000 that came from a guy that I actually didn't know, a stranger.
That's pretty cool.
Right? Which was pretty cool. And that was kind of
how'd you find him? How did that happen?
How did he find them?
He found us.
Yeah.
Wow. I don't even know. Like Google or SEO or, who knows.
Okay.
And then we went on to our second transaction. And our second transaction, somebody wired us $500,000. And we had like a really remedial CRM. It was an Excel file and it said people's names, who they were assigned to at our company. There was like 3 people at our company, right? And so it was assigned to one of the guys at our company and I called him in the morning and said, have you ever his name was actually Jack. I said, have you ever talked to Jack? And he goes, no, I've never talked to Jack. I said, okay, well, I'm going to call Jack. Like he just wired us $500,000. Like, so I pick up the phone, I call Jack and I go, Jack, I'm the CEO here. I want to give you my personal cell phone number. Thank you so much for investing with us. And this was an apartment deal in Kansas, by the way. So like this was our second or third deal. And he said, the reason I'm investing with you is because I don't have to talk to somebody. And he hung up on me, right? So this guy had $500,000, hung up on me, and I'm like, wow, I think we might have something here.
That's kind of the dream,
strangers want to give us money, right?
And
this is
not
incredible.
Speak to us,
and not talk to us, So
that's amazing.
That's actually really funny. Okay, so you started with this lending business. It built up. Jack wires you $500,000.
Yep.
And where do you take it from there?
We start doing more equity deals. So, predominantly in apartments, any sponsor that we could find that needed like $500,000 or $1 million, right? Mm-hmm. We were growing sort of slowly, went from 110,000 to 300,000 to 500,000 to 600,000. And it was hard, right? Because a lot of sponsors for $1 million or $500,000, it's too much brain damage, right? Just bringing in a third party and figuring it all out. And so it was really the early adopters that I'm really grateful for to this day. Who believed in it, right? And who said, I want to build a relationship with RealtyMogul today because in the future, I want to be one of your sort of premier sponsors or premier partners and sort of be there from the early days.
And are there some long-term sort of legacy?
100%. Nice. There's folks who we've been working with for a decade, which is really, really cool to see. And they started as small companies and today they're, billion plus in AUM.
So I think that's another interesting point that you bring up, right? Because there's 2 themes here. A is that your business has matured. Like you guys have grown and hit certain milestones.
Yeah.
But crowdfunding is in its infancy still. It's funny how that moves so much slower than where you've taken the business. So when you started raising more equity, how were you guys like educating people? Like what was the pitch at that time, especially on those small checks, like when you're raising $1 million?
Yeah, there's got to be a lot of kind of skepticism, I imagine.
Yeah, huge amounts, right? These are strangers on the internet, right? Yeah. And so like one of our big breaks definitely came during COVID when people became, and look, at that point in time, we'd been in business 7 years, right? But people really became a lot more comfortable investing online, putting their bank account credentials online, right? We're integrated with Plaid, which essentially allows an investor to, integrate with their bank account and then wire or ACH money over to us. A lot of people were afraid to do that. We used to have that as an optional option on our website. Now it's required, right? And that's we don't have sort of option B because there's the level of comfort that the investor has or that the potential investor has. And so a lot of it was not only getting comfortable with RealtyMogul as a brand and getting comfortable with real estate investing generally, but it was also just transacting online. And that's evolved a lot. So we've kind of, been great beneficiaries of that just from a business model perspective.
Are you looking to build sustainable wealth and achieve financial freedom? Viking Capital can help you do just that through multifamily investing. With a team of seasoned real estate experts, Viking Capital conducts deep financial analysis and data-driven asset management to deliver outstanding returns.
Yeah.
So I want to take a step back to the 2012 Jobs Act.
Sure.
Because this just changed everything.
Yeah.
I mean, this was such huge legislation, basically now allowing accredited investors to invest in things that they never would be able to invest in before.
Right.
What do you think the impact of that has been on the industry? Has it been good, bad? I mean, I guess obviously it's been good for you and, for your business, but, we keep seeing so many horror stories now of sponsors crowdfunding, and they're taking advantage of a lot of, mom and pops.
Yeah. A lot of syndicators. There's obviously a lot of syndicators who pose
tons, right? We're all on social media. We've
met good and bad ones.
It's a little over the top, the cheesy factor, right? Of raising money on social media for a lot of these syndicators. Not to say that they're not all sophisticated, good sponsors. Some of them are, some of them aren't.
Right.
So I guess what would you say investors should be on the lookout for?
Yeah, I mean, first of all, I don't think that crowdfunding created this problem. Like this existed well before crowdfunding, right? People just did it in a different way. They were hanging out at the country club. They were playing a lot more golf, right? They were building relationships. But well pre-crowdfunding, there's been crappy real estate companies and good real estate companies, right? And so when you're looking at sponsors and at syndicators, I mean, a lot of it is background, right? Background, size of team. I mean, I can't tell you how many times someone will submit a transaction and we look them up on LinkedIn and like they don't even have the company listed on their LinkedIn. And so we ask for an org chart and we get an org chart and it's one guy and his secretary. And we're like, that's not interesting. But they have this appearance of being sort of a bigger company. So we do a lot of checks that way of, who else is on the team. We get org charts. We want to see, if you're running 10 people at a real estate company, you're probably starting to be pretty legitimate, right? If you're 3 people, probably not where you need to be, right? I also always dig in deep into who's doing the asset management because I find that, no offense, acquisitions is easy. Asset management is really, really hard, right? And again, a good sponsor can work a bad deal. A bad sponsor can't work a good deal, even in a lot of cases. And so I really dig deep into the org charts, look at their track record, look at their history. I prefer not to work with real estate companies that haven't been through a cycle because going through a cycle tells you a lot, right? And how they handled it. I mean,
we're seeing it right now. Yeah.
You're seeing it right now. Right. And there's a lot of sponsors who have floating rate debt. There's a lot of sponsors who are in trouble and on our platform too, right? Anybody who took floating rate debt in 2021 is in a challenging position.
And the only way to get a deal done in 2021, 2022
was to take floating rate debt.
That's right.
100%. So should everybody have, sat on their hands and not done deals? Maybe. But I now have kind of a firsthand seat to see how different sponsors are behaving with their floating rate debt, right? What are they doing? Do they have good relationships with the lenders? Are they able to negotiate? Are they able to raise additional capital to, finance cash and refinances, right? Do they have good relationships with pref equity providers where they can buy themselves another day? Or are they just throwing up their hands and going, I don't even know what to do, and we're selling it in a fire sale before it gets foreclosed on? Right. And it's really been quite informative to watch how different sponsors behave in that environment.
Yeah. It's truly, I mean, you really see also just the character of people. When shit hits the fan, I think that's when you really see someone's true character. And I've seen it in the last, year or two. I mean, you start to really see it now. And so you can tell now who the people are that you want to back next time around based on how they've kind of handled things.
Yeah. Although the ones who are getting hit really hard are going to learn a lot.
That's true.
Right?
That's
they're going to learn a lot. They're probably not going to make the same mistake twice. Although the reality is that, the same opportunity to make that mistake may not come back again. Right. It's going to be a different mistake. But, there are folks who are in transactions with floating rate debt that, ultimately there could be some equity loss that I would 100% do business with again. Right? Because of how they showed up, because of, how deliberate they've been around running these processes. What's the right thing for the transaction? Is it bring in pref? Is it sell it and take some of a loss today? But we think that that's going to be a greater recovery of equity than, tomorrow. So it's been really, really, really interesting to watch.
And that's a good point, by the way. You're doing pref as well, and still doing debt or not doing debt?
No debt. No debt. We've been out of the debt business largely since 2015.
Okay.
Yeah. Okay.
How are you handling capital calls? Right. That's something that I think it's coming up here and there.
Yeah.
Do you have any? I'm sure at some point in the past it's come up.
Yeah.
What's the process there for RealtyMogul?
Yeah, I mean, the same way as any real estate company, right? So we're going out to the investors in the transaction and we're calling capital. We've raised millions of dollars for capital calls at this point. A lot of it is for either extending rate caps for extensions or cash and refinances, right? So those are kind of the two primary, I would say, sources of, or uses of capital rather, for the capital calls. But the same way that you would in an offline situation, we do in an online situation. So we notify the investors, sponsors provide them an update on the transaction, what they think is going to happen with the transaction as a result of the capital call, and same structure.
Are they getting a specific pref usually with whatever additional money they're putting up in that capital call, or?
It is all over the board. Shockingly, I would say there's not a market for capital calls today. Some of it is like 10% member loans, and people are funding into that. Others are building a new class of kind of preferred equity securities, and they're paying 16, 17, 18 on it.
Yep, I've seen that.
I've seen like probably 18 is the peak of what I've seen.
It seems to be the magic number.
Yeah. But I've seen some 16s. I've seen some 14s, and again, I've seen 10 and 12% member loans. Yeah. So it just really kind of depends on the transaction.
Right.
Okay.
Yeah, but I wouldn't say there's an efficient market at all.
Maybe that's an idea. Let's think of it.
Yeah. There you go.
You can democratize capital call space.
Can we talk about
bad idea? Highly unrecommended.
Yeah.
You heard it. Just bad idea.
The nature of that whole business just attracts problematic projects, which is a great place to start.
I want to hear more about the REITs
Sure.
and what made you decide to get into the REIT structure. And these are public, non-traded REITs.
Yeah.
Can you kind of go into what those are for folks that may not know?
Sure.
And why you chose to get into them?
Yeah, so we have two REITs. One's an income REIT and one's an apartment REIT. So we focus on sort of different types of projects across those, although they're pretty heavily multifamily. We're fully transparent about all the assets that are in those REITs. So you can, pull them on our website or pull them on the SEC site because they're, filed publicly with the SEC. But it was really about giving investors diversification. So we had a bunch of investors who would come to us and say, I don't like your platform because I don't want to pick and choose my own transactions. Can you do it for me?
Yep.
And for many, many years, we said, no.
Who are these people? Can I meet these people? I have never met a single investor like this in my life.
We have some deals
tens
for
of
them.
thousands of them.
Please. Introduce me to Jack or whoever.
They write small checks, right? They write small checks.
Sure.
So they might be writing $20,000. Our minimum on the REIT is $5,000. So they're kind of bite-sized, entry level.
So that's one of the advantages, I guess, is a lower threshold.
Yeah, much lower minimum to kind of get involved. And it's fascinating. We have a guy, he's probably worth $100 million, and he started with a $5,000 investment in the REIT.
Wow.
And when you ask him why, he goes, well, I was testing you. You said that there may be, monthly distributions. Did I get them? Did they come in? They're not guaranteed, of course, but
and
we
has
see
he
people
upped
test
it?
us. Oh yeah, he's invested in a lot of, individual assets now.
Wow.
But so we kept having people come to us and say, can you do it for me? Can you do it for me? Can you do it for me? And so we said, okay, if we're going to really do this, we should build an investment advisor. So we built a registered investment advisor. Its clients are now the REITs. We built an investment committee and an advisory board. And so we started, making investments on behalf of the REITs and doing it in a way that we have discretion over the investments. And, those investors can buy in at a smaller dollar amount.
Mm-hmm.
Yeah.
Can we, so the REIT vehicle, I think actually makes a lot of sense, right? Because it's kind of similar to the nature of the platform itself, right? Like people are looking for it, probably why it's mostly multifamily. It's like the easiest to understand cash flow, right? It's all the things that resonate with someone. So then the REIT structure makes sense too. I just blanked on where I was going to go with that.
No sweat, but I mean, I'm curious. I mean, the REITs, everything's, happy Monday. Everything's, it's not Monday, but.
Is today not Monday?
No, dude. I'm joking.
Today's Monday. You can't get me that bad.
So I know it's predominantly multifamily. What's the future hold, right? I mean, you're obviously, I know you're trying to diversify more. What's next? What's the big product type that you're trying to get into?
Yeah, I mean, look, they're public, so I can't pontificate around, where we go in the future. But I think that we're always looking for market opportunities, right? Where's the opportunity in the market? Where's the gap in the market? Where do we think that there might be risk reward gaps, and that's where we try and play. But we do so in a way that it's pretty right down the fairway. Like if you look at the assets that are in those REITs, we're not doing anything esoteric. We're not doing anything crazy. We're not investing in distressed office as an example.
Yeah. Oh, maybe you should though. I mean, Alex has some deals.
It's a demonized space.
I actually think there's a huge opportunity there though. The folks
no one wants to invest.
Control their emotions and get in that space are going to make a lot of money, I think.
Yeah.
Are there regions you don't want to invest in, or are there states or coastal cities or places that you're concerned about?
We were smart. We didn't do any of the North Dakota Balkans, right? We probably saw...
Was that a hot market?
We probably saw 100 deals. 100.
What's going on over there?
Yeah.
And that was a COVID
shale.
thing.
Yeah. Shale, oil. We probably saw 100 deals, and everyone I just said like, nope. A lot of what we choose now is based on investor sentiment, frankly. Mm-hmm. So, you're a Texas guy. Like a lot of investors don't like Houston as an example, right? So not to say that we'd never do a deal in Houston, but we just don't have a lot of appetite.
Yeah.
We don't have a lot of appetite in Chicago, right? And so, we see those deals. We've done some in the past, but
what's that?
we're not doing a lot.
Chicago's shrinking, or
I think people are afraid of crime. Yeah. Chicago's shrinking. You've got, tax issues, just kind of all kinds of things that make people. Yeah.
Is RealtyMogul structuring any funds?
So the REITs are funds. Okay. And then, occasionally we do structure, other funds as well. And we'll also raise capital for funds on a selective basis.
I think that's more of what I was getting at. Are people coming to you to get investor dollars to raise funds?
Yeah, they are. So we've raised a handful of funds. I'd say that the individual transactions is a bigger piece of our business, but we can work in funds as well. Yeah.
I have a question just about just getting this off the ground, right?
Sure.
It must have been really difficult to have a core group of investors with also finding deals. There's that balancing act of finding the appropriate amount of sponsors and deals, but also having enough investors to back that up. So you're basically selling on two fronts.
Yep.
So tell us about that.
It's still hard.
Okay.
Right.
Yeah.
We're a decade plus in, and it's still very, very, very challenging because you also have the market dynamics, right?
Mm-hmm.
So let's go back to 2021 when the market was really hot. We couldn't find projects fast enough. We had so many investors that wanted to put capital into real estate transactions because it felt like, where investors should have. Now, in hindsight, it was probably one of the worst times to put capital into real estate. But we couldn't grow as fast as, otherwise we could have with capital because we didn't have enough projects, right? Today, we have more projects than we have capital, which is interesting because you'd think in a time like this, it's really when investors should sort of manage their emotions and jump back into the real estate market. We're seeing some really compelling opportunities, but it's always a balancing act, right? And it's always out of balance. It's probably the hardest piece of building this company are the marketplace dynamics. And so what we have to do, and frankly, what we've chosen to do is just grow slower. We could grow faster if we made different choices, but we've just said, let's grow slower. Let's be, more deliberate. There's a lot of people who haven't made it in this industry, and I think it's because they haven't been as deliberate and they've tried to grow, more rapidly. And we've just said, play the long game, right? Real estate is a game best played long. And so if we're going to be a real estate platform, just play the long game.
Got it.
I think one piece of what you just said is there's kind of like this wall of why so many people have been slow to adopt crowdfunding model.
Yeah.
How do you, it's the certainty, right? Can you talk a little bit about the process if a sponsor lists their project, let's just use any apartment deal, like a general acquisition, doesn't even have to be some crazy backstory.
Sure.
But how do they get the certainty to the raise? And I say this all knowing it's a bit of a self-fulfilling prophecy because as you grow, the more money that comes onto your platform, the more they'll be able to see execution. But is there a dollar size of a deal right now where you can hit gaps? Like if I list $100 million project, do I still only come up with like 50 or 60 million bucks? Like, can you talk about that a little bit?
Yeah, 100%. And really, how do we gap it? So I would say a lot of the sponsors that we're working with today, they have their own balance sheets, right? And so timing is really one of the core issues.
Sure.
How quickly do they need the capital for that acquisition? If somebody comes to me tomorrow and they say, Jilliene, I have a great deal and we're closing in 20 days, I can't help you, right? Like it just doesn't give us enough time unless you have a balance sheet, right? A lot of times we'll have sponsors will come and they'll say, I want to raise, $7 million of equity and I'm closing in 30 days, but I can put the $7 million on my balance sheet and then we can list it and, backfill
so it's a recap tool for some people.
It could be a recap tool for some people. We also have a balance sheet. So we'll bridge stuff on our own balance sheet. It depends on the transaction, depends on sort of the trajectory. So that's an ongoing conversation with, sponsors depending on the transaction. Development deals typically don't need it, right? They've got a lot of time and, the equity is almost like never the problem. In today's world, it's typically, the debt or getting the GMP lined up or, it's typically not the equity. So on the acquisition deals, it's usually either they have their own balance sheet or we can use, our balance sheet or just we have the track record to tell sponsors what we think is rational. The platform has now had over $1.2 $2 billion of equity transacted, through our technology. And so we've got pretty good instincts and pretty good guidance on kind of what is going to resonate with investors.
Yeah. Yeah, that makes a lot of sense.
And we just turn down stuff that's not going to resonate, right?
Sure.
If you bring me a distressed office in Houston, it might be the best investment, and we're going to turn it down because we're not going to have investor appetite.
I hope that when I bring you the distressed office in Houston, you grab me and you say, Alex, we need to have a talk.
We need to chit chat.
Yeah, be in my corner, please.
Yeah, cool. Well, so I also want to know kind of in this environment, what should sponsors, in your opinion, be looking for? Where's the low-hanging fruit right now? Is it distress? I mean, you said right now you have some distress deals you're looking at.
Yeah.
I may know of one or two, but tell us, like, what type of deals are you finding right now?
I mean, look, I think that if somebody is brave enough to wade back into office, there's probably some really phenomenal trades there today, right? The challenge is that it's almost impossible to get capital. So, where some of the best opportunities are, it's very, very challenging to find capital. We're really not doing a lot in office just because we don't have the demand, right? I think that there could be some great opportunities there on the supply side. We are seeing distress in multifamily. So investors or sponsors who took out floating rate debt in 2021, that debt is coming due. They either have to do big cash and refinances, if the lender won't extend it. In best case scenario, the lender will extend it and you have to come up with capital to do, an additional rate cap. That's best case scenario. But that's not happening across the board, right? There's sponsors and lenders who are just saying, hey, get me out of this or I'm moving to foreclosure. And I'd say that's where we're finding the majority of the distressed deals that are really interesting to us right now. We're looking at a handful of deals and involved in a handful of deals right now where the sellers are essentially selling at the lender's basis. Yeah. And they're selling today because they don't want a foreclosure on their track record. They want to get out before the lender forecloses, and they're taking, a really, really painful pill to swallow, right? The equity's getting wiped out, but it's almost exclusively sponsors with floating rate debt that was originated in 2021.
Yeah, not a surprise.
2021.
Not a surprise. Yeah. What is it that you think RealtyMogul has been able to do to survive throughout these years that's different compared to some of the competitors or the copycats? I mean, I know it's kind of difficult right now of an environment for everybody a bit right now, but you guys have weathered a lot of storms. So, what do you think the secret is here? I mean, because I'm not going to throw out names, but there's been other names in the field that just haven't made it.
Yeah. Look, I think the secret is to think really long term. You can build a real estate business that has a 100-year duration, right? Or a 40, 50-year duration. If you're thinking about it in terms of 3 years or 5 years, like you're off on the wrong foot to begin with. The second thing is do your best to do right by people, right? So we've turned down a lot of business just because we didn't think that it was doing right by people, or we thought there was some issue with the transaction, even though in the short term we could have made money. So again, it's kind of that like long-term, view. And then the last one is just like survive and be relentless. It takes a lot, and this is entrepreneurship generally, right? Like I wouldn't say this is specific to our business, but the reason that companies shut down or go under is because ultimately the entrepreneur gives up, right? Like there's always a way if you're unwilling to give up.
Yeah. Was there entrepreneurs you said in your family, anyone in real estate in your family?
So my brother ran a mortgage brokerage in Orange County. So he was the CEO of a mortgage brokerage company for, 20, 30 years. He's retired now. But yeah, he went on the mortgage side.
Got it.
Yeah.
Got it.
Your parents, both entrepreneurs?
Both entrepreneurs. Yeah, actually my mom was in real estate too, luxury real estate, residential.
Okay. Hey, my mom was in residential too.
Yeah.
Totally different. And when I first got into real estate, I thought that's what it was even for commercial. I had no idea, but is she still in real estate at all?
No.
Yeah. I bet it's got to be pretty cool to have your kid go on to do some pretty amazing things.
Well, they invest with us, which is really fun.
Yeah, that's really...
My mom will call me, should I invest in this deal? Should I invest in this one?
Is it fun or stressful?
It's so funny. So my parents are older, and my mom really, really wanted to invest in a development deal. And I said, you're too old to invest in a development deal. I don't have a problem with a deal, but like you're too old. You should not be investing in development. It's high risk, potential high reward. And she completely ignored me and went on to invest in the development transaction. So that really tells funny. You how much she believes in my... I mean, it's development, right? It's not built yet, so to be determined, but
that's really funny.
It was pretty funny.
Are you looking to build sustainable wealth and achieve financial freedom? Viking Capital can help you do just that through multifamily investing, offering a powerful way to grow your wealth passively. Passive investing with Viking Capital allows you to benefit from a lucrative world of real estate without the hassles of day-to-day management. Their team of seasoned real estate experts takes care of everything from sourcing high-potential properties to managing them efficiently, so you can enjoy the returns without the stress.
I want to turn this around. So this is always a tough call on this because sometimes people are like, "Hey, we want to cover more, substantive real estate information," and then other people are like, "Hey, it's really boring. I don't want to just hear about."
That's me. I'm that voice.
So I want to ask.
I'm boring you?
No, not you. I'm usually the one to say that
that you get bored in general.
My problem is that we get such interesting people on like yourself, and I feel like there's a lot more that you have to offer to our viewers.
There's so much. I know.
Yeah.
I wanted to talk about Burning Man real quick because I just to me it's so fascinating.
Let's go, spit it out.
We can always circle back on some real stuff.
No,
so I know you have visited Burning Man. For those that don't know what Burning Man is, it's a really cool festival concert venue that is way too cool for me. I think I've tried to go like 3 years, and each time I end up.
Can we give the backstory of like why this is coming up?
Yeah, because I saw
it got sparked because of something very contested.
I saw it on Jillien's LinkedIn post, and so tell us about Burning Man. What do you get out of it, and why are so many successful people and entrepreneurs attracted to that festival too?
It's wildly creative. So for me, it's just like being reminded of the ingenuity of humankind, right? And it's a desert, right? So it starts as literally a desert, and in a matter of days and weeks, people collectively build a city. And it's like 70,000 people. So imagine building a city in a couple of weeks. It's just it's phenomenal, right? It's sort of mind blowing. And for me, it's all about creativity. Like I love the art. There's incredible people who go build, amazing art. There's probably 200 or 300 art cars now. I'm not sure if you know what an art car is, but they're beautiful and they're so creative. And it's a good reminder for me of like what you can build, right? And what people can build. And, when you get down on sort of mankind and a lot of hate and anger and decisive or division in the world, and you go to a place like that and you just see that like ultimately people want to be happy, right?
Yeah.
People want to be optimistic. People want to do good. Yeah. They want to build things. And so it's just like a wonderful reminder of that for me.
Until they get back to New York. And then it's like,
well, I mean, the one rub I have about it is like, in New York and Dallas too, and other big cities, it's not like it's like tech bros that I see going to Burning Man, and they do it because it's like, I think they're doing it for like the Instagram versus like the experience. I might be wrong, so I'm going to get a lot of hate about that.
I think that's probably true in anything, right?
Fair enough, yeah.
It's probably true in anything. You always get people who are there for whatever appearance.
The wrong reasons.
What's your tenure of going there? Are you
I've been 5 times.
5 times.
Yeah.
Yeah. Okay. I know a lot of people like to brag about how long they go because the times have changed.
It's funny. I wouldn't say I really brag about it, but look, it's a really eye-opening place where you're reminded of how creative human beings are, right? And I think like to have that as a reminder a couple of times in your life is really, really powerful.
It is really cool. I mean, for those that don't know, just Google it. It is some of the coolest images and visuals of anything you'll ever see. It looks like something out of Mad Max, but not
and incredibly
Mad Max.
Friendly people. Like in New York, I don't walk up to somebody in the street and say like, "Hi, how are you?"
Why not?
Right?
That's a surefire way to get punched in the face.
You meet a lot of friends, right? You meet a lot of interesting people. You meet a lot of friends. You meet friends of friends.
Yeah.
So that's been a
so
fun
what
piece.
else? What else do you do in your life that keeps you sharp and active and allows you to get back to business every day?
It's a great question. I read a lot.
Yeah.
I love to read. I
Fiction,
read a lot.
nonfiction?
Both.
Yeah.
Yeah, both. I travel a lot. So, I travel for work a lot. I'm always running around to see, the next greatest apartment building. They all sort of look the same now.
Do you go to all of them or most of them?
They all
like,
do look the same.
They all have the name Woods at the end of it, or there's like a whispering. Or
I did read one study.
Something
this is
Oaks.
A stupid side note. I did read one study that like showed depending on what you put at the end of the apartment complex, whether it's like woods or grounds or
Oaks.
Whatever it is. Like it broke out the premium that you receive per apartment
what was
complex.
at the top?
I don't remember, and I've spent years trying to find this article again because I thought it was so interesting, and it was like something that I was an analyst, and I saw it and I was like, oh cool, and I might have bookmarked it somewhere, and then spent years trying to find it again because I was like, I wanted to see if that was true.
Yeah. Well, now have you noticed, like when people go in and they implement these value add projects and they want to rebrand the property, they'll just rebrand it by putting like the in front of it, right? So it's like Oaks Apartments. They'll rebrand it to the Oaks.
It's expensive to rebrand an apartment.
I know it's not cheap. I know.
You gotta change everything.
Signage, marketing.
You're right.
Digital presence. It's not cheap.
Where have been some places that you traveled to recently that you've enjoyed?
I love Japan. Japan's, one of my favorite. I lived in Japan actually prior to starting the company. When I was working back in banking, I did a stint in Tokyo.
This is exactly why we stopped talking about real estate.
We want to hear about this. This is so cool.
So
what were you doing?
To go back to Japan.
What were you doing
I was working with their wealth management business. So at the time I was working in wealth management in the US.
Okay.
And it was owned by a Japanese company. So Mitsubishi was the parent company of the US based bank. And they wanted to take sort of best practices from wealth management in Japan and bring it into the US.
Okay.
And one of the big ones was that the banker traveled to your house, which, they've done in, America for the ultra wealthy.
But
these were for
the who don't want to speak
the middle tier, right? Exactly. Exactly. It all comes full cycle.
Where Tokyo?
I was in Tokyo.
Okay. What's your it's on my bucket list. I mean, it looks amazing and it's so different, which is really cool.
It's so clean. It's so quiet. Like it's a wonderful, wonderful place.
How is that possible? So, I mean, you come to New York and literally every substance on the street you'll find. Yeah. Literally.
It can kill you.
Japan,
most of the substances can kill you.
Japan, you could eat off the street. I mean, from what I've seen.
It's culture, right?
Yeah. Can we ever do that here, do you think?
No, it's impossible.
I don't think so either.
No, not happening.
What city do you think could come closest to doing that in America?
Probably the name is escaping me, but the new city that they're building north of San Francisco with all the tech folks. Probably that.
Yes.
Yeah.
Have you heard about this?
Yeah.
It's actually
they're trying to restart basically their own.
What's the name of it? Do you guys remember?
Man, I forgot the name of the guy. Gamble introduced me to him, and I actually spoke to him.
Of course, Gamble did. We had Alex Gamble on the other day, and he's just brilliant entrepreneur and coming up with modular housing technology.
Yeah, whatever. He's okay.
He guy knows everybody. So Alex always starts off, well, Gamble knows him. He's always like, Gamble knows him.
But I
think that would be it. I think that's going to be like idyllic. And
do you think they'll pull it off?
I think they'll pull it off.
Yeah.
I do. Yeah.
He seems to have a good team.
Yeah.
The one thing that I don't know how I feel about it yet. I'm trying to internalize it. So I'll externalize it with you guys.
Please.
The team building the city, like they're not real estate people.
That's probably a good thing.
Well, I'm curious. So, as you know, there's plenty of cities who, when you look at local governments, generally nobody's a real estate professional, right? Yeah. So your city planning commission tends to be a little
shocker,
upside down.
That explains why New York's a little
in most areas, not all areas, in most. But now they're building a city and like, you don't have one real estate person.
They must have at least one.
I'm sure there's one. But it seems like he's using a lot of external, like, oh, we'll hire this group to tell us. So like this architecture firm will tell us where to put these people. But I don't know. I don't know how I feel about that. You immediately said probably a good thing that he's got no real estate people. Yeah, because they'll be like,
they're building
triple net leases. Right? Here and then just put them all over there or something.
I think they're being very intentional about building community.
Yeah.
Right? And building connections and sort of creating the concept of like water cooler throughout an entire city. Like that's pretty cool.
I hope it's not just a bunch of McDonald's and franchises.
No, I think it's going to be none of that.
I think it's not permitted.
Yeah. He's trying to do, like, if I recall, it was like the highest walkability in the country and like most interconnectivity. Yeah.
Bicycles, tricycles.
Nice. So not Houston. I'm just joking. Someone's going to give me shit for that. Like, I love Houston, but there are parts of Houston that are just incredibly unwalkable and just fast food deserts. But that's not just Houston. So
it's ideal.
The other one I would say is the villages, right? The villages in Florida, the retirement community.
Yeah.
A lot of happy people.
I
wouldn't say it's quiet, so it's not quite like Japan and being quiet, but a lot of happy people, a lot of community, a lot of connection.
Yeah.
So. You get a ton of market exposure. Is there any city in particular right now that you're bullish on?
We're really bullish on Columbus, Ohio. We're doing a lot in Columbus. In fact, we're under contract on 2 deals. One's closing next month, one's closing the following month.
Is some of that the corporate relocation, not relocations, but there's some new manufacturing.
The new Intuit manufacturing facility, the affordability characteristics. So it's still affordable and incomes are really, really high and, certain pockets, obviously. So we're really excited about that market and spending a lot of time there. I'm actually going there tomorrow.
Oh, nice. Wow.
Yeah.
Nice.
Yeah, I've been hearing a lot about Columbus as well. So, I mean, it's interesting to hear about the next, I don't know, once you just.
Next Columbus.
Yeah. Next Columbus. Once you hear about it, maybe
Texas,
it's too late.
Jack.
El Paso, Texas, baby.
El Paso, Texas.
It's funny. I did spend a couple years ago, I was doing private equity in like workforce housing. So I spent a lot of time from St. Louis, like through Louisville. And kind of up and down that whole corridor, and like a lot of time in Kansas City, Columbus, Ohio, Indianapolis, throughout Wisconsin, whatever.
Yeah.
Columbus, Ohio. Yeah, it was a really tough market to penetrate, from what I remember. So a lot of like families that own the majority of the real estate there, an overwhelming concentration.
Well, it kind of reminds you of Arkansas, right? Of like Walmartville, right? Bentonville, Arkansas. I remember I toured a deal in Bentonville, Arkansas, 2021. Thank goodness that we lost this transaction, right?
Why is that?
It was selling at a 4 cap.
Yeah.
I mean, why are there 4 caps in Bentonville,
Northwest Arkansas?
That's when I started
crazy.
to pull out of that space, and it was around like 2021 where the date. We already know that majority of those deals were held up by sub 3% rates.
Right.
And if you got some fixed money for your bridge, congratulations. I don't know how it ended up on the back end, but congrats to you there.
Yeah.
But when I started seeing perpetual 5 caps in Kansas City, I was like, this doesn't make sense.
Yeah. Well, I think 4 caps in Bentonville, Arkansas are worse than 5 caps in Kansas City.
Pretty insane.
So.
I'll concede to that.
But that 100%. Market is like all, Walmart money.
Right.
Yeah. All family money and Walmart money. And so that's a very, very hard market to get into. As is Salt Lake City. I mean, Utah is also, largely controlled by, Mormon families who like to do transactions with one another. And, that market's done incredibly well too, but a very, very hard market to penetrate as well.
Yeah. The Walmart thing is kind of interesting because I feel like there's a subsect of that economy that you can capitalize on, just being like, Walmart's not leaving Bentonville, Arkansas.
Yeah.
You can build there.
You can bet on it.
Yeah.
Well, we had fun. I mean, look, we talked about everything a little bit. We kind of touched on, we could talk for hours just about RealtyMogul and what you're doing at RealtyMogul. But, we touched on the REITs. We touched on how you started off. We even touched on Burning Man.
The way that we end these things is we like to get the interviewers.
You tell me. I don't know. How do we end these things?
As if you don't know that. So I do rapid fire math, and we just see how fast you can answer.
That's right. Yeah. Just.
All right.
I like normally good posture. That was it. That was the test.
Alex will ask your credit score.
I'm a dork. I mean, come on. Like
we're
ultimately,
all dorks. Yeah. Normally he asks your credit score and who you're voting for.
Yeah, we like to do this bit called Alex's hard hitting questions, where I just see what people are willing to give us.
It doesn't matter. It's 15 viewers, so
it's all. What's your relationship with your parents? But yours sounds good. So
tell us. Let's just wrap this up and tell us, where do you think the future of crowdfunding is going in real estate? What's next? What should we be on the lookout for?
Yeah, we're early days, right?
Okay.
I mean, you can raise $1 billion of capital on the internet. What does it look like when you raise 10 billion of capital on the internet, right? And so, as much as I wish that this, business had evolved faster, like we're still very, very early days. There's millions and millions and millions of accredited investors in this country who have never heard of crowdfunding, let alone crowdfunding for real estate, let alone RealtyMogul, right? And so, I view this as a very, very long trajectory. And I think where we're at in the real estate cycle, someone asked me recently, if you look at a clock and 12 o'clock is the top of the market and 6 o'clock is the bottom of the market, where are we on the clock?
Yeah.
And my answer is we're definitely closer to 6 o'clock. I don't know if we were at 4, 5, 7, or 8, but we're definitely not at, 10 o'clock, 11 o'clock, 1 o'clock, or 2 o'clock, right? So we're definitely closer to the bottom than the top. And so I think that's really exciting for investors. One of the things that I try and coach our investors on is controlling emotions, because a lot of people are emotional right now, right? There's capital calls, they've lost money on deals, they're concerned about, real estate generally. And it's really unfortunate, because I think now is the time when you can sort of dollar cost average in, right? And when you know that we're closer to 6 o'clock than 12 o'clock, I don't know if we're at the bottom, right? Again, are we on the 5 o'clock side? Are we on the 7 o'clock side? I have no idea, but I'm excited about that, because I've been waiting a long time for this cycle.
Yeah.
It's been a long time since we've had a cycle, you know? And so there's a lot of exciting and interesting things to do in a cycle. So
so checks get bigger, gets more accepted.
Yep.
Just bigger and grander.
Yep.
Wow.
Exactly.
More projects.
Yeah.
More projects, different types of projects, a lot of diversity, and the opportunity to serve different needs, right? I gave the example of my mom and telling her not to invest in a development deal, but there are plenty of people who that is the right risk profile for, right? And then there's plenty of people who, core deal earning 7 or 8% is the right risk profile for. We've spent most of our time in sort of the value add space, but there's no reason that we shouldn't have core and value add and opportunistic as, the business evolves.
Right. Makes sense.
Yeah.
Okay. Well, Jilliene, thanks so much for coming on.
Thanks for having me.
Yeah, it was fun.
Absolutely.